So let's take a big snapshot here of what we're dealing with, and let's assess maybe some of the risks within this company to give you a good case study as to kind of the conversations I have, what I see often. So let's just look at this. We have two shareholders. We've got two business owners who partnered up together here in this venture. We got Bill and we got Tim. Now, Bill and Tim, let's say, has 3 pharmacies in the city. They got 3 locations. Now, let's just say the arrangement is 50-50 to keep things simple. Now, if Bill and Tim each have a holding company, which typically I would recommend in this circumstance if there's multiple locations, because each location is going to have its own operational entity. Now, if we have Bill having its own holding company, owns 50% of operational company number 1, 50 of 2, 50 of 3, Tim 50, 50, 50, etc. So where's the risks? We look at who is vital in this company's operations. It looks like we got about 15 employees between all 3 locations. Now we got Alan, Maggie, and Troy are the key, managers, store managers for each location. And now below them, they got other workers and different receptionists and what have you in each of these locations. So we look at the big picture. Now, Bill spends a lot of time in location number 1 and 2. Now, between Bill and Tim, they really kind of oversee number 2 because Maggie is just so good at her job. And then Bill really kind of looks after, location number 1, works with Alan a lot. Tim works with Troy a lot to kind of oversee what's happening with operations in location number 3. So we look at, now obviously Bill and Tim are vital to the company. Now, if they were to pass away or get diagnosed with a critical illness or, God forbid, have a heart attack or stroke, and they would have to step back, it would definitely disrupt operations with that specific company or location, obviously. So we know that Bill and Tim are vital. Now we're looking at the managers. The managers are overseeing things when Bill and Tim are either away or maybe they are there and they're kind of just handling the small fires, putting out the small fires. But it's really Bill's and Tim's responsibility to take care of the well-being of the business. So Bill and Tim are taking care of the bigger problems, I should say, or putting out the bigger fires, while Alan, Maggie, and Troy, it's their responsibility to put out the smaller fires. So who would be compensated, which entity would be compensated in the event of, let's say Maggie, who's a vital piece of these operations for location number 2. What would happen if Maggie were to pass away tomorrow? Now, obviously, with Maggie being so vital to the company, we're going to want the company to be compensated to replace Maggie because it's going to cost money. It's going to disrupt the monthly revenue generated or the operations in that location specifically. And more than likely, Tim and Bill is going to have to work together to kind of step into Maggie's role a little bit till they find a replacement. Now, what happens? You're going to have to train someone. That takes time. What's time cost? Time costs money. So you're going to want the operational, the company to be compensated in the event of Maggie passing away or getting critically ill. If she has to step aside for a couple months, has a heart attack or stroke, she's going to want some time to heal and to take care of her well-being, which is very, very important. And that essentially comes above all else, right? But it is a business at the end of the day, and the business will need to be compensated. So entity number 2 is going to receive a benefit to pay and fund for training a new person to step into Maggie's role, either temporarily or potentially permanently if Maggie is deceased. And that is a perfect example of a manager, key person insurance scenario, right? So, whether you have 1 location or 50 locations, you got 50 managers all over. If you have a key person, key employee, even outside of what you do as a business owner, then you must prepare. You must prepare, taking into consideration, hey, what would happen to my business if my top receptionist, who handles a lot of the paperwork and bookkeeping and what have you, what would happen if she passed away? Am I going to do it? Because I'm on the field working, trying to generate revenue for the business. Who would take over her position, right? There's multiple different kind of scenarios where you got to really look at the well-being of the business as the business owner, because that is essentially your responsibility. So we would look at that. Now, if Bill and Tim have a buy-sell agreement, okay, a buy-sell agreement, or a shareholders agreement between both of them. Now, we gotta review that shareholders agreement. Now, a lot of these partnerships will have an existing shareholders agreement in place, but I often ask, when's the last time that was reviewed? And a lot of the time, it's been a while. They actually don't know. A lot of shareholders don't know when's the last time their shareholders agreement was reviewed, which is a problem because things change. Right? As your business grows, as your business, has more assets, potentially has more liabilities, maybe the corporate structure did change a little bit. We got to look at that. We got to review that. How is the shareholders agreement funded? Is Tim planning on going to the bank to get funding to buy out Bill's shares in the event of Bill passing away? Or is Bill going to the bank to buy out Tim if something happens to Tim? Or are they going to pay for insurance for pennies on the dollar when in the event of either Tim or Bill unexpectedly passing away, to have the benefit there to buy out the deceased shares from the family, right? So understanding that there's multiple different areas of risk within this. Now, we didn't even get into how to retain kind of these employees. Maybe there's strategies to help retain employees. We didn't look at corporate CI, which is another very, very useful strategy where you can start protecting you as the business owner and also start extracting money out of the corporation on, in that case, a tax-free basis. Which is very, very cool for any company that has stagnant funds within their holding company. Hopefully it's in your holding company if there's stagnant funds. We look at how can we turn that stagnant funds and start putting it into a position where it's performing or saving on taxes to extract that money out of the corporation on a tax-free basis. When you do that, essentially, it's almost like putting your corporation's money into a GIC that's paying between 7 and 9%. That's kind of the rough numbers. So if you know how to do it, then it's like you're making 7 to 9% on your corporation's money, which who doesn't want to do that, right? So this is just a very, very simple kind of layout of what we look at being in the financial risk management industry. We work with tax consultants. We work with legal professionals as well, and pretty much together we create a team and we create a custom, comprehensive, I don't like this word, but plan to really super boost the business owner into a better position financially and better protect them, obviously. So with that being said, if you're looking for a guy, hey, maybe just to get a second opinion, feel free to reach out to me, reach out to your local advisor, or feel free to reach out to me if you'd like to just see what your business would look like on this whiteboard, and maybe we can work together to identify some potential financial risks in your situation. That being said, have a great rest of your day. My name is Rory. Thanks.